ag volume. And remember, with ag volume, the key to ag volume is, again, the same as the key to fundamentals. It's about recognizing a reaction to the ag volume and then tying it in with other things that happen. So when I see ag volume here, what was the reaction to that ag volume? Was it bearish or bullish? It was bullish, right? So almost immediately, we think that there's going to be a volatility expansion to the upside, don't we? You see what happens? If we get big volume and it then goes above it, we don't know it's going to go above it until it goes above it, right? We are now expecting volatility expansion in that direction. So it starts to tell us where fast and slow is likely to come in. Understand? So when we get volume on the break here, that's that volatility expansion that we thought we were going to get. And what did they do with the volume here? They made it bid. They held on to the bid. So that confirmed the bullishness of the markets, correct? So if you know it's confirmed the bullishness, what are you going to be doing as a trader? You're going to be buying downticks into these key references, aren't you? You're going to start drawing in some technicals. You're going to draw in these level 2s. You're going to draw in these technicals. You're going to draw in the change of behavior. You're going to draw in the dealer's edge. You're going to draw in the bottom edge. And you're going to start thinking about being a buyer of the markets. And interesting that we got an ag again coming in at that point at exactly where we got the ags the last time. And what did they do with that ag? They bought it, which gives us a third confirmation that the market's bullish. We've now got 3 confirmations that we should be long gold. You see how easy that is as a narrative? 3 confirmations that we should be long gold. So when we get those lower prices, coming off of prices that we know about, coming off of levels that we know about, coming off of key wholesales that we know about, we're now looking at this and saying, well, I think there's going to be a volatility expansion, and I think we're going to go after the top edges. Because you've now done 3 separate analyses. They've all been bullish. And what happens? We get an absolute rip through the top edges, as if you wouldn't have known that already, as if it would have been impossible for you to have figured that out. It's crazy, isn't it? And we go from a spike high to a spike low, and we come up with a target price. And we say, right, well, we are now looking at a target price narrative, and you know, when we got the volume coming in here and the volume coming in there, so the volume came in here, the volume came in here, the volume came in here, and the volume came in here. It's all on the upside. It never was once purchased. Never once was it purchased. And then we got to a target price, which kind of nulls all the volumes and all the analysis, and we go back now to the drawing board. And the reason why we go back to the drawing board is because obviously now the volume is being related to the previous volumes. You're not going to get any ag candles to read into. So we've got to do that work for ourselves. So when I see a volume candle, I don't need an ag to tell me. When I see that volume candle, and I draw a line against that volume candle, and I look at what they did with the volume, I can see that they tried to go higher, pinned it, tried to go higher, pinned it, and then it drifted below the volume. And then you can see that there was volume coming in here on the sell side. So you're obviously recognizing that that volume had no upside potential, which means I'm starting to form an opinion that there's at least a temporary downside potential. So when that volume came in here, I'm watching for that volume to have potential downside movement. I would expect it to. So obviously I'm going to be trying to sell back into that supply. And selling back into the supplies made a very, very nice splash back down to the downside. And look at what happened. Look at what happened. Now you might be saying, okay, but, okay, I know where you're going with this one. Surely they bought back into this volume. Yes, they did. Absolutely. They bought back into the volume. So I'm now expecting them to have a volatility expansion to the top side. Absolutely. And they did have a bit of volume here and a bit of expansion here. But when we see the volume coming in here and it doesn't go any higher, I'm now looking at a rotational market here now, correct? I'm looking at a rotational market. It did not go any higher. It pin rejected the top edge. So we're now looking at that and saying, well, if that's the most recent decision, I still have this underlying idea that the market still has some downside potential here. You're always making your decision based on the last piece of information that you've got available to you. We've already seen them buying it once. There's no reason to suggest that they might not buy it a second time. So when the next time comes in and we get another spike in volume, there's a very good chance they're going to buy that spike in volume. And they did. And the gold price went up a little bit. But we're already making this idea, this read, that that's at higher prices than that. This is about the same, but this is lower, this is lower, this is lower. And you get the basic idea that when we start seeing these volumes, we should be doing what? As a trader, we should be trying to be short, selling into these areas. And you can see, obviously, we then got this cracking sell-off on the non-farm payrolls. Look, it was all just supply lines coming in, wasn't it? Every single one of them was a supply line coming into non-farm payrolls. Just because, Sam, it calculates an average volume on the spike, and it's part of that calculation, isn't it? But we don't need it. We can see it for ourselves. We don't need to use the indicator. I mean, I don't use the indicator most of the time. I just have it on the screen. So for demonstration purposes, I don't have any volume indicators. So, you know, the problem you've always got with indicators is it's got to be a certain threshold before it triggers. It's got to be a certain percentage, and there's got to be a certain look back before it triggers, that type of thing. And that's always the challenge you've got with any indicators. I mean, you can see that there was quite clearly a massive spike in volume here that didn't have an ag candle. Does that mean it doesn't have massive volume? No, it just means it doesn't qualify because it wasn't big enough. Because of all of these volumes in the background, this volume wasn't big enough. But when the volume drops off, that is big enough, and now we get an ag candle. But it's just a demonstration. It doesn't mean we do trades against that. We simply make sure we read the trade ideas. But the key to this is this idea, and this is what we talk about, for example, at the cash open. One of the things you'll see into the cash open of the equities is that we get this drop-off in volumes after 2:30. What is my signal following the cash open? What I always tell you my signal is following the cash open to start leaning on something. There's always a little spike in volume around about 12 minutes after the cash open at 42, 41, sometimes 40. Nobody knows that, no? I've mentioned it about 1 billion times. I'm surprised. But about 10, 11, 12, 13 minutes after the cash open in the equity space, I look for a little increase in volume. It's never going to register as an ag volume. Never going to register as an ag volume because it's going to always be related to that cash open volume, and it's never going to be substantial enough. But when I see a drop off in volume and then a spike in volume, I am now very, very, very wary of making sure that I read that candle. So when I see a huge volume series here and it drops off, and then I see a spike in volume here on a small candle, you're already getting a read on that's probably going to be a buy reversal, isn't it? You don't have to try and buy it on the way down. You could just wait for it to turn back round and buy it on the way back up again. You know, you don't have to make a decision on that. But that is now a buyer coming in with the sell side volumes. You've now got the possibility that there's a bottom edge starting to form in here. And you're starting to look at that as a probability. Makes a lot of sense now, doesn't it? So it doesn't have to have ag volume. The ag volume is really good for, you know, looking in the background to see that type of shape when we get these outstandingly large volumes. You know, when you look at that and we go back to this idea of what we did in yesterday's classroom, I know obviously, as I said before in the classroom, it's always going to be hindsight when you do this exercise, but you can obviously improve the exercise a little bit. You know, you can improve the exercise a little bit, but you get the basic idea that when we go from blue into red, this is the direction that the market should be now trading in. When we go from red back to blue, that's the direction. Now, obviously, we don't know that's going to happen until it happens. That's something, but we do know it's going to happen when we see these red candles or blue candles jamming into those price areas. So a lot of people say that this is an unfair exercise because we don't know what's going to happen. We're just talking a load of bollocks. We can watch to see if it happens. That's the point, right? That's the point of using these ideas is we look for the reaction against the blues. We look for a reaction against the pinks, and we can tell if the blue goes offered, well, that's it, it's reacted. If it goes back bid again, well, that's okay. It's opened the door to a continuation move. The point is that it's an RGL, right? That's the point. So there we go. There's your gold. And just like we did in yesterday's exercise, when we then look at gold during those periods, you'll start to see some really, really interesting stories. You'll start to recognize how the storyline evolves, when it becomes really important to recognize the volume getting jammed in certain areas and how to try and deal because it got jammed in certain areas, and to then take advantage of it from that point going forward. It's the same as the fundamental data, isn't it? It's almost identical to the fundamentals. Is everybody starting to make this link now, all the new people that came in? When we get a good data result, it doesn't mean the market's going to go one way or the other. We need to read the reaction of what the market does, which results in a narrative that looks a little bit like this. Heavy shorts, rotation on misses. We read that. In other words, I should be able to look at this information here and do it for volume. Correct? So volume, sell side volume, heavy rotations, buy side volume, volatility expansions. And all of a sudden, you've now got an asymmetrical narrative. Very clear asymmetrical narrative now available for you to read into, make a decision, and get your play going. So when we see that asymmetrical narrative forming, we use it. That's why we do it, right? We're trying to find information that gives us a leg into a trade idea. The leg into this trade idea was to be short equities based on those pieces. A leg into this information is to be long or short gold based on what they do with the volume narrative in those areas. What they do with day highs, what they do with day lows, what they do with delta traps, what they do with. And this is what I mentioned before, this is what the spot gamma guys finally came across in their own investigations when they crunched their own numbers. Some numbers, some very positive gamma numbers, the market sold off from. And some very positive gamma numbers, the market didn't sell off from. So is it the gamma that's important? Well, of course the gamma is important, but is it the gamma important to tell us about the direction? Yes or no? No. No, right? Is that making sense, guys? Is the gamma important? Yes or no? Yes. Is it important about telling us a direction? No. What does that mean? What it means very simply is that when we get a gamma coming in the direction it's supposed to be bullish, but the price jams and goes bearish, then the market's bearish, guys. It doesn't matter that it's positive gamma. They've sold to the positive gamma. Is the gamma important to recognize? Yes or no, Ab? Absolutely. But all it gives us is what? All it gives us is what? All it gives us is a point of interest. All it gives us is a question mark. All it gives us is an attention grabber. Yes? All volume ever does is an attention grabber to say, something's happening here, guys. Switch on. Let's get a sensible read on this. Volume's that. Gamma is that. If you're looking at Voltics, that's it. If you're looking at your deltas, that's it. Does delta tell us what direction the market's going to go in? Yes or no? No, delta doesn't tell us what direction the market's going to go in, does it? But delta is, does that mean delta is not important? No. What is important is the market's reaction to the delta, the market's reaction to the cash open, the market's reaction to the data, the market's reaction to the top of the hour, the market's reaction to the takeout of the top edge liquidities, the market's reaction to the volumes. It might be positive and it might be negative. So that's what's critical, isn't it? That's why we get this call to the screens. When we get the call to the screens, we're being told, you've got to try and make a decision here, guys. There's something that's not quite right. There's something that stinks to high heaven here, and I don't know what it is, but let's see what you think of it. And when you saw this big volume coming in here, see that big volume there? What did they do with the volume? Well, they've held it on a long position, haven't they? So for the time being, you can now recognize that big volume there and say, well, it's still bullish. So guess what you're going to do? You're going to try and buy dips. You're going to try and buy dips. You're going to try and buy presses. You're going to try and buy rallies, right? And we had a little inside rally, the classroom that we did yesterday. Does everybody see we had a paycheck squeeze just there? Yes or no? Paycheck squeeze. So you could have bought this at 1833s on gold. It's just traded 1835s for $200 on a paycheck squeeze. On a paycheck squeeze. And could we have done the same when we saw this type of setup here for an intern's press here? Yes. Beautiful field auction, press clean through, interns press away from what? Interns press away from this bullish volume that held on, which was still bid, right? So we had a bullish volume in that candle there, seemed to reject it, then it rejected it, then it went bullish, and then we got the press. And that's in line with the volume that came in there as well, isn't it? When we got an immediate buy reaction to that volume, we're now thinking to ourselves, I like this. And then we got a rejection of the bottom edge, I like it even more. And then we got volume at the top edge, I like it even more. And then we got a rejection of the low price on that volume, I like it even more. How many buy signals do you need to get before you start bloody well buying this thing? They're all over that bottom edge of the chart, are they not? Everything that appears at the bottom edge of that chart tells me that this is going to go up. What we've got to do is get into it. And we've done two interns trades, this intern trade here, this intern trade here, and sure enough, this intern trades went from 29 to 37s. That intern's trade is now up $800, and this little intern's trade here at 33s is also up $400. That's a $1,200 rally right there in gold per contract. Per contract. You read the roadmap that is being left for you. The market gifts you information through the process of footprints being established. You can't hide the footprint. You can't hide the reaction. If they're going to make money, they've got to do something with the volume. We read that story, the Charlie D transition experience, in all its color, in all its glory. We read the reaction to the event. The event brings our attention. The event tells us feck all about what's going to happen. We read the reaction to the event. We make our decision. We line it up with the rest of our ideas, and we execute every time. And that's how easy it is to make a big splash on that gold trade. Big splash on the gold trade. Because unless the story changes, you've got to keep going with the story. If this volume went offered, well, we're not going to be buying it at higher prices, are we? So when we saw the gold coming in on this candle here, the price never went back above it, did it? Yeah, price never went back above it. we'd already seen the volume coming in this candle. And it did go back above it, but immediately snapped it back into the sell again. And then it never once went back above it. So we're still saying that this is sell side. When the price does not go back above the volume again, still sell side. When the price doesn't go back above the volume again, still sell side. And obviously the price never went anywhere near the volume that time, and it just collapsed. Sell side. You read this one and it's still sell side, and you read this one and it's still sell side. Well, what are you going to do? You're not going to be buying it anytime soon, are you? Sell side only business. And then you get that enormous profit from that drop. It's $1,000 on the sell since 1 o'clock. And that's another $1,000 on the buy since 1 o'clock. That's a $2,000 buy side, sell side rotation just using volume. Just simply using volume, $2,000 per contract. People think trading's difficult. It's not if you just make sure you just keep asking that question. What did they do with that volume? What did they do with that price? What did they do with that level? What did they do with that information? You got your big S&P sell-off on the NASDAQ because of that. The big S&P sell-off, sorry, on the non-farm payrolls because of that information. You got your gold sell. You got your gold buy because of that information. Just read and react to what you're seeing. Read it, react to it, or wait for somebody to react to it. Make the read on the reaction, and then plan a trade idea, plan a trade execution against it. So what have they done with this volume? Well, we don't know yet. It looks like they're selling it. So that could put the gold into an end game, couldn't it? So they haven't sold it yet, but they could sell it. This could be now a short developing. If they don't, and they don't go back below this price area, we know that this is still going to be bullish, and we still go after the press then, don't we? We still go after the press. It's crazy when you think about it, guys, but just do it. Stop putting the inevitable off. At some stage, you've got to do this stuff. It's the only way you're going to start getting that success is by reading and reacting to the auction that you find yourself in.